for years, one of my specialties was trading financial stocks. And it was always kind of fun because the financial stocks tend to lead off the earnings season. It was nice to be at the forefront of that. But one of the lessons that I took away from that was the banks are incredibly unique and idiosyncratic. And what I mean by that is, first of all, you'll see that Bank A will go up after earnings and Bank B will go down, and the different, each of them on the surface might have more or less hit their number. But there's so many moving parts within particularly a large bank, that investors will focus upon, that the top line numbers are often, I'm not going to say meaningless, but need to be examined very carefully. For example, markets tend to look through trading results. Usually what I've found is they look through the good trading results and say, well, that's what they're supposed to do. When the trading results are bad, they get angry because, well, you're not supposed to lose money, but over time, it's really how it adds up. Hopefully you make more than you lose. So the markets tend to look through trading results, but then there's things like the net interest margin, there's loan growth. There's so many different things going on within a large bank's income statement and balance sheet that it becomes very difficult. And also especially in this environment now, banks are in a very, I'm going to say, fluky position. The market is in love with growth stocks. And right now, the banks are at best a value stock. They tend to trade at low price to book values. And one advantage they have now is, especially after the last CCAR stress test results, they're allowed to return much more capital to shareholders. So those buybacks tend to put a floor under the stock price. Those dividends tend to put them much more solidly in the value category. And there's not a ton of top line growth. Whether or not we get interest rate cuts, remember the yield curve is inverted, at least at present, or has been flat as a pancake, if not, for some period of time. Banks typically do best when there's an upward sloping yield curve because they will borrow short term and lend longer term, and that's not a profitable activity if you're borrowing above where you're lending, or at least if you're not really able to maintain any spread. And then the other thing is about interest rate cuts. At least if you're talking about the big money center banks, they're not paying their depositors anything anyway. So the cost of money really doesn't go down that much, at least in terms of their deposit base. So these are things that really weigh against the banks. So in a growth fixated market like we're seeing now, where everybody wants to talk about the high tech stocks or anything else that's a growth type of play, the banks are sort of a fun, interesting sidelight, but do not really shed a whole lot of light on the rest of what one might expect from earnings season. The only thing that I would really tend to be focusing on here as a bellwether for the rest of earnings season is, what are they saying about loan demand? What are they saying about loan growth? And because big companies and small companies and individuals do go to banks for money. If there's demand for money, if they see loan growth, if they see activity on housing, that's a good sign for the economy and plays into various industrial stocks and all sorts of stocks in various ways. And the banks are a good window into that. So don't necessarily take the top line, bottom line results, whether or not they beat by a penny, missed by a penny. Remember also, banks have the biggest couch cushions in the world because they can time when they realize profits and losses. But do look through the numbers, look at the commentary, see what they're saying, and if you feel that they're pointing to a robust economy and robust growth, then that's a good sign for earnings season to come. If not, that's kind of a tricky one. And as of now, what we're seeing are mixed results, and so the picture is murky.